Now, in the last week or so, European bond prices have dropped in a widespread sell-off. Now, this has sent yields from bonds higher as the markets brace themselves for the return of inflation. Well, Billy Bambrough has been talking to the experts about why this is happening.
European bonds have gone haywire recently in the worst bout of volatility since the Eurozone debt crisis. Some experts believe the sell-off is simply a correction to the strong rally in bond markets this year. Richard Maguire is a fixed income strategist at Rabobank and thinks that the sell-off rout in the last 2 weeks was caused by fundamentals, but that's only half the story.
We think that the trigger itself was arguably fundamental. The consensus view has been to play ECB QE from a liquidity perspective, but by that to go long core debt because there is limited supply of core bonds and the ECB is buying. Therefore, that should be a positive, and the value of these bonds should rise and the yield should fall. In fact, many believe that is a no-brainer. However, we've long argued that there are two elements to QE. One is certainly, yes, the central bank is buying, but the other one is more fundamental, which is QE is also stimulus, and stimulus can result in higher inflation expectations. And that was certainly the case in Europe, where even as core curves were rallying, so yields were falling as investors were buying, inflation expectations were rising quite rapidly.
With sovereign bond yields usually not moving by more than a few hundredths of a percentage point in a day, the volatility caught a lot of investors off guard. Richard says some of the investors he's spoken to have been worried.
I wouldn't think of it so much in terms of vulnerability. I think more in terms of sensitivity, perhaps. I mean, what's clearly been demonstrated is something that we have spoken about with investors in recent weeks and months, in fact, which they have been concerned about limited market liquidity and have worried about how easy it would be for them to exit their bullish positions, their long core, their long periphery positions, as and when they would wish to do so if others were also trying to exit at the same time. So the analogy that we would make is when you're entering the market and going long, it's you're going through the door, but if everybody tries to exit at once, they've all got to squeeze through the keyhole. So I think going forward now there will be a greater sensitivity to this issue, which I think would mean two things really. One, we're seeing an improvement in market sentiment today, and as of yesterday afternoon, peripheral spreads narrowing, core yields are falling. I don't think that this will be a linear progression such that we retest the earlier bond yield lows, simply because investors will realize that as it is difficult to exit these positions, there is a first mover advantage here, which means that the market is likely to be a little bit more skittish. You want to be the first out of the door should sentiment turn. So I think that challenges the notion that we will retest the lows in terms of yields. I think we have already seen them, and I think going forward this means that we should expect volatility to remain elevated in European bond markets.
Wealth management expert Jonathan Davies says this is only part of a long-term trend.
Certainly the case in the last few weeks. The borrowing rate for our government, as in the Gilts rate, has risen materially. I'm not convinced we have any particular volatility, movement up or down in gilt rates, or indeed as the corollary is in gilt prices. To me, this is just natural movement. When I look at the last 30 plus years in interest rates and gilt prices, I see a very long-term trend down in borrowing rates, and equally, therefore, a very long-term trend up in government bond prices. And of course, within that trend, there is going to be some volatility. But anyone who pulls up a chart of interest rates or bond prices will see that it has been pretty straightforward in one direction, whether you're looking at rates or prices, for 30 plus years. And as far as I'm concerned, looking forward, interest rates will continue down in the medium term at least, and bond prices will continue up in the medium term at least.
Jonathan thinks there are parallels with what's going on in European markets and in Japan.
the reason why we see interest rates continuing to fall and bond prices continuing to rise, that's government bond prices, I hasten to say, is because our view, and indeed we coined the term, is that the UK and indeed most of the West is turning Japanese. Now, what do we mean by that? Well, as everyone knows, Japan as an economy pretty well peaked in 1990, 25 years ago, and then went into not quite a depression for the next generation, but certainly a great malaise. They call it the lost decade. Actually, it was the lost over 2 decades. And in that era, what we saw was interest rates kept falling to practically nil, and bond prices continued rising through the roof. And indeed, it came about because Japan had disinflation from a very low point, in other words, falling inflation, and indeed for much of the 20 years it was in mild deflation. Actually, that's what I see is happening in the UK and the West. What is the current CPI? 0.0%. We've got governments and central banks throwing nuclear weapons economically to create inflation, and yet we have the lowest inflation stat in 2 generations. That, to me, says that we are in an era, certainly, of disinflation and probably mild deflation, and it will continue for a very long time. Thus, your listeners should be investing in government bonds for the medium term, and they should enjoy interest rates falling, particularly if they've got debts.
The fall in bond prices in recent days has coincided with the rise in the net supply of Eurozone bonds, which is due to fall back in June and July. The resulting squeeze, some say, could fuel a further rally in the market.
And that was Billy Bambrough reporting on recent bond market volatility.